Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
Let's talk current market conditions. Oil is pushing higher. Stocks are pushing lower. That's the trend. We're at the end of March. They say that if this continues into June and July, that oil will go to between $150 and $200 per barrel. The headlines aren't great. Rising gas prices are weighing on fast food sales already. We're seeing that. We know that this is a K-shaped economy right now. The wealthy versus the middle class and the lower incomes. And the wealthy and the lower incomes get hit the hardest in rising inflation scenarios. Year-to-date, Brent crude is up 66.7%. Silver's now down 5% for the year. Gold's up 1%. Listen to this. Bitcoin's down 22%. The Morgan Stanley Country Index down 4.5%. The Magnificent 7 down almost 13%. The Russell 2000 down 1/3%. The NASDAQ down almost 8%. The S&P 500 down 5.5%. The longer this goes on, the markets move from barely being down to a correction, 10%, to a bear market, 20%. If this is still going on in 45 days, approaching summer, it's going to be a problem. That probably requires a bear market to end it or something along those lines for a buying opportunity. Let's talk about some of the headline news. Iran has rejected a U.S. ceasefire proposal. Brent crude's over $106 a barrel. The S&P 500's on pace for its worst month in a year. Now, I find that to be actually a really good thing because I'm long-term and I don't want all stocks at all-time highs on a regular basis or all stock market indices. Stock market is hostage to Trump's new Iran war deadline. He extended his deadline, and I was like, dang it, let's finish this. And by extending it, it can drag on another week, another 2 weeks, another 3 weeks. Crude prices jumped on that extension. The U.S. 2-year Treasury yields increased 4 basis points to 3.9%, near an 8-month high, reflecting inflation concerns. The bond market is sending signals investors may not want to ignore. The move in the 2 and 10-year Treasury yields, along with price action in the iShares 20-plus year Treasury bond ETF, which is ticker symbol TLT, is suggesting shifting expectations around growth, inflation, and policy. Taken together, these indicators can carry broader implications for risk. It's unusual for bonds and equities to decline simultaneously. The last time it did this was 2022, a very rough year on the stock market and a very tough year to retire. Typically during times of stock market weakness, investors look for a flight to quality or defensive posture in the bond market. Not this time. The 2-year U.S. Treasury note, ticker symbol TU00, its chart shows how strong the short end of the curve is sold off, keeping in mind that yields move inversely to prices. The OECD, the Organization of Economic Cooperation and Development, said the Iran war will push inflation above 4%. This came out yesterday, and it's not good. Now, the United States estimates are still lower than that within the Federal Reserve, but inflation spiking to 4.2% this year due to the conflict in the Middle East, that would be significantly higher than the group's initial estimate of 2.8%, as well as the Federal Reserve's 2.7% projection. A prolonged period of higher energy prices will add markedly to business costs and raise consumer price inflation. President Trump said yesterday that Iran allowed 10 oil tankers or maybe 8 oil tankers to pass through the Strait of Hormuz as a present. This doesn't mean that much to me because typically on any given day, 50 to 60 tankers go through the Strait of Hormuz. The VIX index, Wall Street's fear gauge, hit 27.5, indicating elevated market uncertainty and potential volatility. Wall Street turned to oil watch duties. The hopes of a productive ceasefire talks between the United States and Iran have dimmed ahead of President Trump's deadlines. As this conflict elongates, It'll add to both upward pressure on crude prices and treasury bond yields, both of which are likely to prevent stocks from escaping their current downturn. Any credible de-escalation could trigger a renewed risk-on move. But for now, uncertainty remains elevated. Middle East disruptions continue to ripple through the energy markets, with gas prices still more than 60% higher since when the conflict began. These effects also bring in bond markets around the world as investors price in renewed inflation pressures that may likely require the world's major central banks to raise interest rates. So please pay attention to the bond market and the stock market right now. Neither are working, and the oil market's creating inflation sooner rather than later. As the Iran war enters its fourth week, the Strait of Hormuz remains effectively closed, choking off 15 to 16 million barrels of oil per day. There's been a lot of attacks on key energy infrastructure, which have disrupted refineries throughout the Gulf. Oil analysts say the conflict is unlike any in history. There's a company called British Petroleum. Their chief economist, Gareth Ramsey, said the war in Iran is incomparable with any past oil shock, both in its scale and wide-ranging impact on the energy markets. I don't think you really compare this with any disruption in the past. It's greater than. He believes the Strait of Hormuz disruption is every analyst's study piece in college or worst nightmare that we thought could never happen. The disruption that we have right now is the largest on record for the oil market and will likely have long-lasting consequences for the energy sector and surrounding geopolitics. If you go back to the 1973 oil embargo, the repercussions lasted for years, decades. This story is just beginning to unfold. Goldman Sachs is now predicting that Brent and WTI will average $85 and $79 a barrel for 2026. So that's up from 77 and 67 respectively. So 67 was what they started this year at on the low end. Now it's up to 79. 77 is the high end, and now that's up to 85. In 2027, the bank expects Brent and WTI to average $80 and $75 respectively. The new price targets take into account a longer disruption, strategic inventory rebuilding from, and the response of policy, demand, and supply. Countries won't want to get involved in this kind of mess again. They've become a little bit too lenient or too easy or too willing to accept the problems in the Middle East, so they're going to look for their oil elsewhere or different routes. Elsewhere in news this week, OpenAI announced it'll shelve its erotic version of ChatGPT indefinitely after a major delay and investors voicing concerns. They also shut down their Sora app 6 months after it launched. That is a company that is looking for things to fall into place correctly, and they can't do these side quests anymore. Maybe down the road. A federal court dismissed X's lawsuit against advertisers this week, which alleged that they had illegally boycotted Elon Musk's social media platform. Fannie Mae will now accept mortgages backed by crypto this week. Coinbase and Better Home and Finance partnered to launch a product that allows investors to pledge Bitcoin or USDC for down payments on a Fannie Mae home loan without liquidating their position. Here's how it's going to work. Rates are 0.5 to 1.5 percentage points above a typical 30-year loan. No margin calls. Mortgage terms still hold even if Bitcoin's price declines, but the collateral behind the down payment loses value. The forced selling mechanism is effectively gone. Later today, I'm going to talk robots. Let's talk about what the lawsuit means for Meta. They lost 2 critical lawsuits this week. Social media landscape is facing its big tobacco moment, where once we linked cancer to cigarettes and we proved that corporations were hiding it from users, things changed. I'll tell you about that later in the show. My next big event is the Pints and Portfolios, Saturday, April 18th, 11:30 to 1:30 in Sunnyvale, California. It's an opportunity for you to come hang out at a brewery with me. I'll buy the beers. We'll talk financial planning. It's ideal for people who need to figure out what they're doing right and what they're doing wrong. Sign up for the event at robblackshow.com. robblackshow.com.
Join Rob Black in Sunnyvale Saturday, April 18th for Pints and Portfolios, a less formal event at a local watering hole for those close to retirement with $500K or more in investable assets. Drop by from 11:30 to 2 for a little sunshine and a complimentary preliminary financial plan from a CFP that Rob trusts at EP Wealth Advisors. Whether you're on the road to retirement or already there, this preliminary plan can provide you with a second opinion analysis of where you are and highlight areas for improvement and opportunities for growth. That's Saturday, April 18th in Sunnyvale. Go to robblackshow.com and click the Events tab. Find Pints and Portfolios and click to register. You'll answer a few simple questions about your situation, and your confirmation email will provide all the details on the location of this Sunnyvale event and how to schedule your preliminary financial plan. Space is limited and registration is required, so go to robblackshow.com today. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
Social media addictive like cigarettes? That's exactly what a jury found. That Meta and Alphabet have designed addictive apps. Could social media, being called addictive by courts, be thrown into a big tobacco moment where the big tobacco companies not only market it, but they design their products to be addictive? The sexy ad campaigns paired with tobacco that you inhale into your lungs that had chemicals like nicotine and other things in it to keep you coming back for more. They had to settle with states for billions and billions of dollars. They had to put a big skull and crossbones on their boxes. Here's what the experts are saying right now, as of today. Morningstar said that individual settlements like the $375 million New Mexico fine are manageable. A court-ordered injunction requiring algorithmic changes would be a far more damaging outcome. Wow. Oppenheimer, one of the analysts there is named Jason Helfstein. He maintains a perform hold rating, viewing the stock as range-bound. He's also concerned about aggressive AI spending at Meta. The CapEx growth significantly ahead of Wall Street expectations, and the product isn't looking great. It's not yet. They just delayed their frontier large language model, Avocado. Now, it's important to get it right, but a delay is a delay. Some analysts view the current 18.5% drawdown in Meta as a buying opportunity, noting that Meta is now the cheapest name in the large cap tech with a forward PE of roughly 18 times. Needham said of Alphabet and Google that where we differ is that they like Google. They're buyers of Google on weakness related to California's jury decision in the Bellwether case this week. Tigris Financial has a $945 price target on Meta. That's the biggest on the street. Whereas Arete Research cut their price target from $676 down to $614. They downgraded the stock to neutral following the court ruling, citing limited near-term upside and massive spending commitments. Bank of America Securities reaffirmed a $900 target and a buy rating, viewing the massive user base and AI integration as long-term buy the dip opportunities. Sounds like Wall Street's still pretty bullish. I wonder if they'll change their tune if more lawsuits start coming in. So jurors ruled that both companies deliberately engineered social media platforms with addictive features like infinitely scrollable feeds, video autoplay, and algorithmic recommendations. One of the plaintiffs said she started using YouTube when she was 6 and Instagram around age 9. She argued that the social media addiction led to depression, anxiety, and body dysmorphia. She won big. $6 million plus. 70% of that is going to be paid by Meta, the rest by Google or Alphabet for their YouTube contribution to it. Now, the day before, Meta was ordered to pay $375 million in New Mexico for its social media conduct and not letting parents know or kids know that online predators are a real thing and keeping young people away from them. Those penalties are peanuts, though, compared to the company's multi-billion-dollar revenues, but they could mark a start of a wave of litigation that trickles down to tighter social media regulations. Roughly 73% of Google's total 2025 revenue came from ads, And for Meta, that figure was 98%. It's rare that social media giants are found liable for any harms people face using their platforms. There's going to be another big trial for social media. It starts at the beginning of June in federal court. It puts together nationwide cases from attorneys generals, school districts, local governments, and families. More cases on the horizon, more problems. Also kind of means these stocks may get stuck until we get some sort of result on regulation from the U.S. government, which we've already seen in places like Australia. It's interesting to note that the Americans' daily YouTube and Facebook usage actually dropped a little last year. Americans who report using the apps at the heart of the case has shrunk. Using the apps every day has shrunk. Daily Facebook users down from 71% in 2021 to just 52% in 2025. And yet, half of the respondents to a recent survey said they log in to both Facebook and YouTube daily. The addictive social media features are considered to have a greater impact on younger people, with the same survey finding that a whopping 95% of 18 to 29-year-olds reported using YouTube. Facebook's Meta, the original social network, we often joke about it now that it's the boomer platform, but 2025 figures suggest nearly half of its worldwide users are 18 to 35. Both companies are going to appeal, with Meta saying that a single app cannot be solely responsible for a teen mental health crisis. Mark Zuckerberg in court depositions, or whatever it calls, being called as a witness, he's awkward. YouTube says we're not a social network. But for now, the ruling says the era of impunity is over. The world's doom scrollers might not have been shocked by the verdict, but the tech companies sure were. Two other companies dropped out. TikTok and Snap. They can't afford the fight. Arturo Bihar, he used to work at Instagram. He said he warned Mark Zuckerberg of the dangers it posed to children several years ago. It changed from a product you use to a product that uses you. Congress is going to get involved. They already started talking about it on Wednesday. There's a clause known as Section 230, which shields social media companies from liability for the content that's published on their sites. One of the negatives here might be we get less content, that it has to be limited. And I do Instagram, and I only do it for like stand-up comedians. I like seeing who's out there and who's cutting edge and maybe someone I can go see. The tech leaders enjoy a generally cozy relationship with U.S. President Donald J. Trump. And I have to imagine he's going to have something to say on this, as well as his administration. The courts could order the platforms to strip out all the features designed to keep people there. But man, social media needs that engagement. The endless scrolling, the algorithmic recommendations, the autoplay, and that would be a very different experience, arguably limited social media experience. Meta shares are down today. Yesterday, they were down 8%. It shed $119 billion in market capitalization. There'll soon be a quantifiable number where we go, okay, that's down too much because they could settle all these lawsuits. The stock's now down 10% over the past 12 months, and the company has fallen to being the 8th largest U.S. company by market cap, below Broadcom and Tesla. I agree with the analyst Jason Helfstein at Oppenheimer. Meta is going to be range bound until a competitive new model is launched or more clarity comes around free cash flow. I have a Pints and Portfolio coming up in Sunnyvale, California. It's a good chance early in the day to come meet me and a couple of CFPs and talk financial planning, what you're doing right, what you're doing wrong. Saturday, April 18th, 11:30 to 1:30 in Sunnyvale. I'll buy the beers. I really like doing these events. Sign up at robblackshow.com.
Don't want to work forever? Check out the Retirement Planning Guide on robblack.com. That's robblack.com, powered by EP Wealth.
Let's talk Robotaxis and Robots. Amazon acquired Fauna Robotics, which makes humanoid robots for consumers and businesses. Fauna Robotics was founded in 2024 by former Meta and Google engineers. Earlier this year, they launched Sprout, a $50,000 bipedal robot that's 3 feet 6 inches tall. It weighs 50 pounds. It's designed to be approachable and human-friendly. They signed up Disney and Hyundai's Boston Dynamics as early customers. Amazon has spent more than a decade investing in robotics, primarily for applications in its warehouse operations. It bought Kiva Systems for $775 million back in 2012, which served as the foundation for Amazon Robotics, its division that is focused on warehouse automation. Last week, they announced they acquired a company called River, R-I-V-R, a robotics company developing machines for doorstep delivery. It hops out of the back of the van, brings your package up to the car. Driver gets the next robot loaded up. Amazon's entering the increasingly crowded humanoid robot market. Tesla is developing a robot humanoid version that's called Optimus. They plan to manufacture these in Fremont, California. Other humanoid competitors include Figure AI, which you saw at the White House this week with Melania Trump, Aptonic Agility Robotics, and China's based Unitree. Hyundai's Motional, they wanted to deploy robotaxis at a lower cost. I find that very interesting because that's when we get to mass, and that's when me and you start buying these cars. I'm not buying a $300,000, $400,000 Waymo. The leaders of the robotaxi industry are trying to prove their self-driving technology can scale. That's going to be important. Safety is the table stakes. The challenge now is to make a profitable business case here. Motional, I've known about them for about 5 years in the world of robotaxis. They're trying to focus on the cheaper self-driving technology. So much so that they stopped working for a couple years so that AI can catch up and they can start using AI in their self-driving vehicles. CEO Laura Major for Motional talked about how they got to where they were, and it was just too expensive to launch and to deploy. Then there was this new opportunity that came along with AI and all the breakthroughs with ChatGPT and with larger models. They started building a model, a large language model for self-driving. They had to do massive layoffs. They had to overhaul the underlying self-driving technology that they were working on. Motional's in Vegas now with a team that's the fraction the size of Waymo's. They've got a good partner in Uber. They began offering rides in limited parts of Las Vegas on March 13th. You do it through the Uber app. For now, rides will have a safety operator behind the wheel. Motional said that they will deploy fully driverless service by the end of 2026. So cost was the reason that they got into a problem, and they waited it out. Now they've got a major partner. It's not the same company it was 5 years ago. They didn't pause their commercial development of their technology because it wasn't working. They did it because the old way of building robotaxis was way too expensive. The key shift of moving from a patchwork of specialized models, they now do a smaller number of so-called large driving models that can better adapt across different geographies. And she said, we spent a lot less than Waymo. To her, it's cost per mile rather than a flashy feature that'll separate the winners from the losers. Most people want the cheapest ride. Now, Hyundai is a great partner for Motional. Hyundai is a South Korean automaker. They can bulk order Hyundais. Hyundai can deliver cars off the production line with the sensors and the compute power already installed. One of the more expensive parts of making a robotaxi is the getting a car like a Jaguar, like Waymo does, and then putting the sensors into it after the fact. When Motional gets the cars, it's ready to drive in that day. That's exciting to me. A lower cost solution. Now, again, it's going to be something I'm watching in Vegas. And if I go to Vegas, I don't have any trips planned, but I will definitely take a look. Motional is you got to have a safety operation. That's the messy side of taking real world passengers. And what they're trying to do with their safety monitor is how to figure out how to handle pickup In drop-off, Vegas is a very, very busy location. A lot of people walking in front of cabs. Where's the safest place to pick someone up? Where's the most efficient way to pick someone up? What if someone leaves the car door open? How do you get it to shut back down? Or they're not buckling their car seats. They're focusing on that kind of fixes. Now, if you want to invest in robots, let's talk about this. Wall Street is increasingly fixated on robotics, a sector that once seemed the stuff of science fiction. Now it's approaching practical reality. Fueled by advancements in artificial intelligence, material science, batteries, and sensors, humanoid and industrial robots are on the verge of large-scale deployment. Jefferies did a report this week where they talked about how humanoid robots are no longer just prototypes. They're becoming commercially viable, promising to reshape manufacturing, logistics, and service industries alike. For investors, this evolution represents a rare convergence of technological progress and market opportunity. They talked about how the costs are going to come down from about $60,000 to about $25,000 in the next couple of years for a humanoid robot. The potential for robotics-driven revenue spans the trillions, benefiting companies that make semiconductors, actuators, motors, batteries, and AI processors. While there are challenges, including the potential displacement of human workers, and I think you're going to see, like, for instance, nurses. You get a humanoid robot going into a room and talking to a patient, how do you feel? And reporting it back to the doctor. Nurses are going to have to unionize. Teachers are going to have to unionize. Humanoid robots are entering a critical phase. Jefferies is projecting 1 million robots could be produced annually by 2030, rising to 5 million units by 2035 at an estimated cost of $25,000 per unit. Robots may eventually be more cost-effective than human workers for certain repetitive or physically demanding tasks. Even when factoring in maintenance and electricity cost, which is estimated about $2 per hour for robots, they're going to offer compelling long-term economic advantages for manufacturers. The business potential of robotics extends well beyond traditional factory floors. They can serve in logistics, warehousing, healthcare, hospitality, and even retail. Think about going to not a hospital, but think about, well, you could go to a hospital and meet the greeter in the lobby and what floor is oncology on? Or in a hotel, I'm Rob Black, I need to check in. And it does everything right there for you. Now, we have a lot of that with kiosks, and kiosks have replaced humans. I don't know, maybe 10 years ago, I was driving through California. I stopped at McDonald's, and I was impressed with how their soda machines are all kiosks, and their ordering is all kiosks now. There's humans to help. Investment opportunities are not limited to robot manufacturers themselves. Component suppliers, companies producing the semiconductors, the motors, the actuators, the sensors, it's all going to work together. Some of the key players that I want you to be aware of: Tesla. Their Optimus humanoid robot has captured global attention. The company plans to unveil its third generation Optimus in the near future with the goal of dominating the humanoid robotics market. Tesla's already highly valued, trading at nearly 200 times projected 2026 earnings. So let's take a look at Teledyne, ticker symbol TDY. They specialize in high-end sensors and instrumentation, essential for precise robot operation. Robots rely on accurate imaging, motion sensing, and environmental awareness to function safely and efficiently. As robots become more widespread, demand for Teledyne's products is expected to grow substantially. There's another company called Aptiv. They manufacture electrical systems, connectors, and advanced mobility solutions. Its components are critical for integrating AI-driven control systems into robots, ensuring seamless communication between hardware and software. Investors are looking for exposure into robots without the high valuation of Tesla. They might want to consider Aptiv as a more industrial play. Then you get into names like MP Materials. They produce rare earth elements vital for magnets in motors and actuators used in robotic systems. As robot production scales, the need for rare earths will increase, making MP Materials a strategic beneficiary for the robotics boom. NVIDIA is also, they've already got software working it. Their AI-trained robots rely heavily on computational power. NVIDIA is a leading provider of GPUs and AI accelerators, which stand to benefit from the growing demand for AI processors. Robots capable of performing both physical and cognitive tasks will require robust AI infrastructure, making NVIDIA a key enabler of the robotics revolution. I did a long piece last Friday on the software stack that NVIDIA has and how impressive it is. Some of the tasks that we're going to see robots doing in the next 5 years: manufacturing assembly, logistics and warehousing, which means sorting packages, managing inventory, healthcare for the elderly. We don't have enough people in healthcare. There's a shortage. Robots may assist in surgery, rehabilitation, patient monitoring. They'll augment human caregivers. Then you get into customer service and retail, where they can interact with customers, handle transactions, or manage inventory. Virtual physical integration AI-powered robots can also act as agents, performing tasks such as software development, bookkeeping, or content generation while interacting with physical streams. So robotics needed AI, and AI has gotten robust enough to take us to that next level. The robotics revolution is no longer science fiction. It's an imminent reality. Robots will transform industries. For investors, understanding the robotics supply chain, monitoring technological milestones, and evaluating market readiness are critical. You can find me online at robblackshow.com. Sign up for my Saturday, April 18th event, 11:30 to 1:30 in Sunnyvale, California. Sign up at robblackshow.com.
Join Rob Black in Sunnyvale Saturday, April 18th for Pints and Portfolios, a less formal event at a local watering hole for those close to retirement with $500K or more in investable assets. Drop by from 11:30 to 2 for a little sunshine and a complimentary preliminary financial plan from a CFP that Rob trusts at EP Wealth Advisors. Whether you're on the road to retirement or already there, this preliminary plan can provide you with a second opinion analysis of where you are and highlight areas for improvement and opportunities for growth. That's Saturday, April 18th in Sunnyvale. Go to robblackshow.com and click the Events tab. Find Pints and Portfolios and click to register. You'll answer a few simple questions about your situation, and your confirmation email will provide all the details on the location of this Sunnyvale event and how to schedule your preliminary financial plan. Space is limited and registration is required, so go to robblackshow.com today. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
Investors can get really nervous when the markets hit a volatile period of time, even if it's expected to be a short period of time, a short-term disruption. When you see a pullback of 10%, say on the NASDAQ, it bothers you. It gets into your head. You feel like you've lost money. You feel like you were at the casino and you should have walked away one hand ago. The CEO of BlackRock, Larry Fink, he warns against market timing, saying missing the best days can have your returns. I like Larry Fink. He's one of those guys that when he talks, he throws down wisdom at this point in time. He's urged investors to resist the temptation to time markets, arguing that staying invested through periods of turmoil has historically delivered far stronger results. Over time, staying invested has mattered far more than getting the timing right. He said this in his annual chairman's letter, which was released on Monday. Some of the market's strongest days came amidst the most unsettling headlines. He pointed to the past 2 decades as a stark example. Every dollar invested in the S&P 500 grew more than 8-fold. But investors who missed just the best 10 days over that stretch would have earned half as much. The warning comes as markets are increasingly driven by rapid shifts in sentiment tied towards geopolitics, inflation, and technological disruptions. On Monday of this week, I saw that retail investors are pulling money out of the account. They're the smaller investors. They're the average person. The danger is that we focus so much on the noise that we forget what actually matters, Fink said. The forces behind today's headlines have been building for a long time. The old model of global capitalism is fracturing. Countries are spending enormous sums to become self-reliant in energy, in defense, in technology. He also warned that the rapid rise of artificial intelligence could amplify inequality, enriching those who already own assets while leaving others further behind. The massive wealth created over the past several generations, he wrote, flowed mostly to people who already own financial assets. And now AI threatens to repeat that pattern at an even larger scale. Companies tied to AI have driven a significant share of recent equity market gains, concentrating returns amongst a relatively small group of firms and shareholders. Now, I agree with him. I would find some people like this that you follow, maybe on Google Alerts. And when they have pieces of advice, jump on it. Go to generative AI like GPT and punch in best advice, best financial advice in the world, best investment advice of all time, best managing money advice, best retirement planning, best financial planning for families. One of the first things you learn in this industry is to pay yourself first. I would have to think about who said that. Oh, I remember, it was a financial psychology book. The best piece of personal financial advice ever is pay yourself first. It's almost like an identity you need to embrace. It's essentially as soon as you get a dollar, rather than spending it, you decide to save and invest a percentage of that. Ideally, this is a mindset you learn as a child and instill in your children. If you do this, you'll be a multimillionaire. I don't care what job you have, how far you went into school, it's a slam dunk. I still invest. I've tried to avoid lifestyle creep. My kid wants me to get an expensive car. And I'm like, I like my truck. And it's going to last another 100,000 miles, so you better like it too. People increase their lifestyle expenses too quickly, especially when they get raises. But if you're able to just keep the cost of living low while you increase your income, that's essentially the formula for financial success. Focus on what you can control. Barry Ritholtz, I listen to his podcast. He's the Chief Investment Officer of Ritholtz Wealth Management and the chair. He says, focus on what you can control. Manage what is within your control and ignore things that are outside of your control. Flip on a TV and they're talking about Venezuela. They're talking about interest rates, Ukraine, midterm elections, non-farm payrolls. Every single one of these things is totally outside of your control and can't be predicted. So what can you control? He says your asset allocation, your financial plan, your costs. Be disciplined and manage your own behavior. And then you'll have an enormous impact on how your portfolio does over decades. Christine Minns, Director of Personal Finance. I read her blog. She says, keep it simple. My most valuable advice financial lesson came from a Vanguard founder, Jack Bogle, who taught me the virtue of keeping things simple. I've tried to take that to heart in terms of my own household's financial plan. I like to have a portfolio with very few moving parts where you can easily identify where you do and don't have risk. And the simple building blocks, broad market index funds, are often inexpensive to add to your portfolio. The typical worker has about 12 employers in their lifetime, so many of us are carrying around multiple retirement accounts. So to an extent, be a minimalist when you can. Another person that I like, Meb Faber, CEO of Cambria Investments, she said, buy the world. She says, you need to invest globally. A lot of people have all their money in the U.S. market, and historically the home country bias of investing in just one market has been a no good, terrible idea. Now, I didn't feel like that in 2025 or 2024 or 2023. I have global investments. Mary Ellen Stanek once said, count on time, not timing. Investors can get tripped up focusing on short-term events and trends. I've got a family friend that had his wife ask my wife if he should pull all of his money out of the U.S. markets and invest in China and the yen, just particularly a currency. I'm like, sure, I don't care. That's not what I'm doing. So put together a thoughtful plan with a high probability of meeting your objectives, then stay disciplined as short-term trends and events happen. He's probably freaked out with the Gulf War. That'll be certainly more scary for a lot of people. Cast a wide net. Peter Lynch once said, if you look at 10 companies, you'll find one is overpriced and one is underpriced. If you look at 30 companies, there are overpriced 3 of them, and 3 of them are underpriced. If you look at 100, 10 of them are overpriced and 10 of them are underpriced. The person that turns over the most rocks wins the game, he says. And Meb Faber also once said, don't take undue risks. It was really frustrating for me during COVID period, she said, in subsequent years to see so many young investors hyper trading with high risk 0-day options, prediction markets, and crypto. Young people are time billionaires with a long runway to compound returns. If you put aside a little money and invest in the global stock market, average returns of 10% a year, by the time you are 70, you'll have $1 million plus. You don't even have to do anything. Just don't touch it. I have an event coming up, Pints and Portfolio, April 18th, 11:30 to 1:30 in Sunnyvale, California. You can sign up for the event at robblackshow.com. That's robblackshow.com.
What's the best way to choose a financial advisor? Download our guide at robblack.com. That's robblack.com. Powered by EP Wealth.